There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Hello, Auvorians, traders, students, clients, potential clients, advisors, all the different people we partner with here at First Down. My name is Steve Federer. I'm one of the managing partners here at First Down. I'd like to welcome you to Orlando. I know that I've done a number of casts over the last 3 or 4 years for Auvoria. This format's going to take a little bit of a different change because while I'll still be talking about the Forex and futures and obviously the equity markets, which is primarily what we do here in terms of managing wealth, I think it'd be probably more interesting, especially from a risk standpoint, that if I just look to focus the attention on at least what our thoughts are with the global macro environment, touching on some subjects today, and then at the same time, just kind of talk about, kind of what we see going on. One thing I would encourage everybody listening to this is you could certainly follow me. I'm actually going to share the screen and show a few things, but I would encourage you as you look at maybe any of the last couple of years of podcasts we've put on, or anybody in the investing community that you follow. I always tell people to be on high alert, as we often will have advisors that partner with us, clients that want to hire us, existing clients, students that follow myself for the trading portions. Always pay attention to the gurus that you follow. I can't tell you how many times I come across students, clients that have just been blindly following some subscription or some sort of guru on YouTube. And the vast majority of these people, you can't find them in real life. So I would encourage you, the people that you really truly want to climb into the investment, boxing ring, if you will, or the octagon with, that you do your research on them, right? I always tell clients, clients get sick of listening probably to me saying, make sure you go to the SEC and check them out. If they're a Series 65 fiduciary like myself, you should be able to look them up. What's their track record? How have they done? We try to format our podcasts so that clients can understand what we're doing and all the other folks that we work with, and that it's simple, right? And I'm going to talk to you a little bit about today about simplicity in investing. But the problem I see out there is that everybody's got a narrative to push. We try to be really just neutral on these casts. We're not taking sides one way or the other. We want to present it in a fashion that is educational to, our audience. But at the same time, I always want you to look at any material that's being presented to you with, with sort of a second eye. Just be cautious, be like, not really big, and just test it out, right? Drag them through the mud. So that's all I'm going to say on that. Started off a little comedy here. Thought this was great. This is one of my all-time favorite pictures in finance. That is Mario Draghi. Okay, Janet Yellen, former Federal Reserve Chairman, now Treasury Secretary. Shinzo Abe, he's now he has passed. We wish him well. May God rest his soul. But these are ex-central bankers, and they look just absolutely clueless in this picture. I think it's great. I think, and this is in Jackson Hole in the symposium that they have. but just thought we'd have a little fun with that. So let me go in and share. I know it probably seems confusing to kind of how to get to this, but I always steer everybody first. Just go to firstdownfinancialinc.com. You click on Media Awards. It's just our award page. You can actually see our new book. Steve and I came out if you're interested in retirement quadrants, but just click on the weekly market watch, bring you right to our Vimo channel. You can also go through the Auvoria Prime channel. This has changed around. These guys have been doing a great job. Haven't been as much in the weeds with them in terms of product testing as I have in the past and stewardship and all that, but still a great team to work with. And I'm going to try and maybe do a little more frequent. I've been tied up because we're trying to grow this business, but at the same time, Auvoria's got a lot of really good stuff now. And I want to start off by talking about the markets. And while I'll have a chart of the S&P up here, let's make sure we're sharing the right screen. This is just a weekly chart of the S&P 500. So it's going back all the way through the zero interest rate, what they call ZIRP. Policy period, quantitative easing, whatever you wish to call it, through the pandemic jolts. I should say, actually, let me just realign this here. There we go. I wasn't sharing the full screen. So going through the jolt of the pandemic right here. This was an awesome time to buy, by the way. This is one of the probably the second or third podcasts I think I ever did for Auvoria. You could scroll back through them all the way to the beginning, but we were out very publicly saying, look, we're not a fan of equities, but you're getting them on sale for 35% off. There's no way that the Fed is going to let this market fall apart. Sure enough, they just came, pouring with just suitcases of cash floating out of the sky for the marketplace. And it levitated all markets up into that. And we've had a very rocky period of time since then. But one thing I did want to talk about, which I think is really not getting the, I don't know, it's not really getting the light of focus if you're not reading hedge fund research like I do a chunk of the day. The insolvency problems recently revealed by rising interest rates translated into runs and failures like the Silicon Bank and the Signature Bank. They're really some of the first casualties of what we consider to be a systemic problem that affects the entirety of the U.S. public and private securities markets. And that really just being as simple as a lot of big institutions are not coming clean, or what the market would refer to as marking to market, meaning that you are pricing the securities in your portfolio based upon what the true value is, so that everybody can get a snapshot of what it accurately looks like at this point, right? And you'll catch a fair tone of agitation when I talk about this, because you either get a completely policy-driven discussion around it, which makes no sense for most people. You don't get the straight story. It's too big to fail. It's not. I mean, in the end, there are a number of institutions that have experienced market losses on their portfolios of fairly massive scale of essentially low-yielding, long-duration U.S. Treasuries and agency mortgage-backed securities, and they haven't marked to mark those losses, right? There's a number of them out there, and instead of adequately disclosing and discussing the issue, many of these are just, following up with the dog and pony show that's put out by the C-level executive suite, just saying things like, our position's strong and all this. And, and what really just surprises us, and maybe I'm just oversimplifying this, is that so many of these banks still appear remarkably clueless about it. That they've made big bets on long duration interest rate assets, and they've mismatched it with short-term liabilities, right? In a probably way too oversimplified example of this would be if you have a whole portfolio of these long duration, low yielding, right? And you're managing your investment assets. I don't care if you're a mid-sized bank or large or hedge fund or family office or some sort of sovereign wealth fund. I mean, the smart thing to do is to take this low yielding tranche and get swaps in place to transfer the portfolio out to the higher yielding, better quality stuff, right? And I joke with my son, Evan, who, even understands he's starting to finally take, his first macroeconomics classes. And then I say, Evan, look, it is as simple as this. Somebody has $1,000 bond out there that's paying, 2%, right? And new bonds are being issued right now, same $1,000 at 6%. What's the value of that $1,000 bond going to do, right? It's going to go down. It's a seesaw effect, right? Drop of price, rise of yield. Same thing on the reverse takes place. If the the paper out there is replaced with much lower rated paper, that's just going to continue to be super in demand. So why on earth, as a bank, would you have made just incredibly stupid mistakes with structuring your portfolio around changes in interest rates? And the thing that just really is surprising as well, I mean, just looking at some of the stuff, they have at least a 6-month advance notice that the Fed was going to be raising rates. I mean, wouldn't you, even if you didn't have the process and protocols or the trading team or whatever in place to move these huge tranches, wouldn't you have at least formed that process? So, and it's just amazing to me that, you look at some of these board meeting, or I should say, well, some of the board meeting notes from these banks, but if you look at some of the board meeting members, the vast majority of people making some of the highest level decisions in these boards, they don't even have any experience in banking, right? So look, there's much better examples out there of stronger banks like, Jamie Dimon's Chase, JP Morgan Chase, there's all kinds of that. But in the end, the concern I have for this, without getting too in the weeds, which I certainly talk for an hour on it, is that the valuation tide, if you will, for long duration financial assets is still going out, right? So in our view, it likely won't be coming back anytime soon. So our concern is that there are a great many parties out there swimming naked, right? And to say the problem is isolated and not systemic is foolish. It's essentially faced by all banks and brokers firms today, right? Even the Fed's own balance sheet is mismarked and overstated. So, and I don't really want to bore everybody with getting into how it looks in private equity and other areas of the marketplace. Let's just suffice it to say that, I always have students come up and they're like, hey, Steve, I watch some of your videos. You're like the risk man. You're the risk manager, but yet it's almost like nobody's listening to the risk management discussion at some of these banks. Now, one thing I will say about this podcast is that this by no means is me looking to say, hey, everybody just go out, take all your money out of the banks. And look, I don't really think it's as systemic as some say it is. The ones that say it's going to end in dismal banks just going under are usually just looking to build a subscriber base or something like that. I mean, we're looking for nothing out of these casts other than to inform a fairly large client base we have and our advisors that partner with us, right? They want to have an understanding of what's going on. So with that being said here, let me just shift over a little bit to an equity market discussion. Right now, as we are looking at essentially the hive of the marketplace, and this is just represented by the S&P 500. So January 22nd was the high of the market, right? And arguably since that point, especially since the swoon, right? I often refer to these big outlying candles as extreme outs or fractal lows, whatever you want to call it. In this particular case, it's 3,500. So why did I wait for, the debt deal to get restructured? And by the way, you notice that was out there making the markets crazy too, right? But there wasn't as much panic in the pricing of the markets because they figured they would get it all straightened out. And honestly, they did. And again, I'm not going to talk about how rotten our country's debt is to at least what many on the Hill were claiming was some big success in cutting costs. The problem is that they still have pretty much a blank check until January of 25 for that to play out. In many cases, the S&P and weekly chart. If you guys are wondering what the blue stuff is here on the left, this is what's called a volume profile. It's an aggregate execution in terms of aggregated volume of everything that took place as a trade on the S&P. It's a very, very powerful concept called the market profile, or any kind of volume or time-based profiling in the aggregate is really great stuff to overlay on even the longest term charts, because it shows you where business took place, right? And you can see that the point of control, the center line, right? And this is a longer term chart, so this is going to be stronger. You can see how we were building a flag right around the center point, and now it looks to have chosen to break out. When in reality, especially in periods of time like this, I had my neighbor the other day came up to me and she said, well, is the debt deal solved? Is that a positive for the market? And I said, oftentimes these are a sell the news event. And, it still remains to be seen if this is a breakout or a fake out. I'm on the latter, because with a lot of our older clients that have been riding equities up, especially since there's a chunk that have come to us recently that, saw this in their accounts, some of them down, 200 to 300 grand in $1 million IRA, they're concerned. And they want to lighten up in equities because they want to start to draw income or be more conservative or what have you. So as our sort of safe growth hat recently as specialists in, tactically lightening up on allocations, we're getting a lot of clients out of stocks at this point, right? We actually don't care if it continues to run more. For some of these clients, it's just not the time to be in the markets. Personally, and as I often joke, I could be wrong, guys. But I think you're being given a gift here, right? Before the next shoe drops in the banking sector. And who knows? I could be wrong. We could continue in this, what I call dangerous historical crash down memory lane. I should change the title of my blog. But what it is really showing us is that all we're really doing is kicking the can down the road. And as someone who has 2 children, one of them hopefully headed to the University of Pennsylvania Wharton School of Business soon. But the other child's going to be a teacher, and they're heading into college, and it's a concerning time if you're seeing all this volatility take place in the market. So what do I do, Steve? Well, what we're kind of really doing for clients is that we've lightened up a lot in client accounts. I do see us breaching this 3,500 at some point. It's really just going to depend when the next shoe drops on this banking situation. We could continue to have all the big banks, and even in the big regionals like a Truist Bank, not want to mark all of their losses, especially if they've done a rotten job managing their book, like the 3 that I talked about. Then the market's not. But most of those stocks, I'm not going to go through all their quotes and so forth, but most of them have really dropped a bunch, pricing in that anticipation, right? So now the question is will systemic lead to, and I think that a lot of our attention has been drawn away with the debt crisis and all the crap going on with Ukraine and their various issues with inflation and all the other things that are sort of taking up our time, presidential campaigns, this and that. I continue to just keep the focus on what's going on with these assets. And I pulled a nice piece out. Occasionally you'll see some pieces here. Make sure I get the right screen. Yeah. Occasionally I'll pull some pieces off of Prescott Capital. Guys are actually really good. They're sort of an underground, really good run hedge fund guys that I follow. But they're looking to see that the bigger they come, the harder they fall. And just looking at, where we were at the peak of the tech bubble, as many of you may not know, but we had just lunacy in this period of time. This is actually when I started in the markets in 1997. I benefited tremendously in this lunacy. All the long-term leap options I bought on Dell Computer, which was going up like $5 a day in the summer of 97, bought me a townhouse. But that was my first sort of look into, how to trade options in the markets. But with, it's just outlandish. I mean, look where we are now versus how much greater mega cap, and this is even a bit dated, because NVIDIA has roared up this list in terms of size. So, I mean, I just think that if you have a long time frame in front of you, you could dollar cost average in here in your retirement accounts, which is what we always tell our younger investor clients to do. But if you are an older client, this is a time to probably take some hay off the table, take some risk off the table, and lighten up into a less of a risk-based allocation. And hell, I know this sounds probably to a lot of people like, I can't believe it. Why would you say that? Money market accounts are paying almost 6%. So yes, inflation's coming down. If you guys saw the ISM report, but right now you're getting 6% on your money, approximately, virtually risk-free. Okay. And if you are of the mindset that inflation is going to continue to rear its ugly head, maybe 6% doesn't sound that good. But right now, as I joke all the time, cash is a position, right? I don't have any positions on. Yeah, you do. You're sitting in cash. It is a position. It's a protection. Doesn't mean you keep all your money in cash. It certainly doesn't mean you run out and squirrel your money away in a bunch of CDs at the bank. But money markets right now are paying anywhere between 5.5% to 6%, depending on the institution. So nothing wrong with parking things, getting that kind of return on, no longer idle cash reserves. The last 12 years, we've had virtually no return on cash. So this is a welcome change, in my opinion, for a period of time that's quite volatile. So that's pretty much all I want to say on that. So banking, equities, just what's going on, marketplace. What else did I want to address? Oh yeah, you know what? Let me just show this as well. Sort of on that theme, slightly different variation of our risk management chat. So this is probably one of the more common pieces I give out. There's all kinds of great information on this sheet. I can make it a little bit bigger. But I focus most in discussions with clients and advisors on this, okay? If you have a 50% drawdown, you have to get 100% returns just to get back to flat, okay? If you have a 90% loss, trust me, I've seen it. Oh boy, have I seen it. You have just an absolute monumental return in your recovery rate just to get back to flat, right? So I always joke with, some students, the ones that are right here making lots of losses in a row are not focusing on what's a percent of risk, right? Oftentimes, even though it may not be appreciated, we rarely ever put more than 3% on any single position inside an account, right? Right now, our cash positions are high, so there's a lot more than 3%, obviously, but that's in a relatively risk-free money market account. But, just looking at what can happen in the markets, getting back at, I always tell people from a risk standpoint, the markets will always show you what you're not thinking. Essentially, that all known information, if you believe in efficient markets, there are some out there that do not, but if you believe in efficient markets and a market is pricing in everything, it is an all-knowing beast of current information, right? So it currently knows that there are probably 100 banks that aren't marking their assets correctly. And a lot of them are just taking direct hits to equity, and it's not even appearing on the income statement or the balance sheet. It's flowing right through it. How can you value the underlying common stock of the bank, right? Some of these banks, if you were to apply correct mark-to-market metrics, the share prices right now are zero. Remember, in the hierarchy, the bondholders usually the first ones to get paid, and oftentimes the common stockholders get wiped out. Okay. So that's kind of just some things I wanted to talk about. I mean, I tried in the past to do these podcasts every week, just can't get to it. So I figured this would be a good one to come out with and talk to you guys about. And as always, wish everybody a profitable and safe trading summer. May the trades be with you.